In the financial arena of 2026, a titanic struggle is taking place for the soul of your savings. In one corner, we have gold, the king of assets for over 5,000 years. In the other, we have Bitcoin, the digital challenger that has transformed from a niche experiment into a global institutional powerhouse. The debate is no longer just academic. It is a battle for survival in an era of unprecedented debt and currency debasement. Many call Bitcoin digital gold, but as we move through 2026, we are discovering that while they share some DNA, they are fundamentally different beasts. Gold's case, as the ultimate store of value, is built on a foundation of physical reality. It is a chemical element that cannot be destroyed, created in a laboratory, or printed by a central bank. Every ounce of gold ever mined still exists today in some form. This physical permanence is why central banks across the globe, from China to Poland, have been dumping their paper currencies and filling their vaults with gold bars at a record-breaking pace throughout 2024 and 2025. They aren't doing this for profit. They are doing it for sovereignty. Gold is the only financial asset that is not someone else's liability. It is the ultimate insurance against a system that is increasingly fragile. In 2026, as national debts reach levels that many experts believe are mathematically impossible to repay, gold serves as the silent witness to the failure of paper money. Bitcoin, however, offers something that gold never can: absolute, programmable scarcity. While the total supply of gold is unknown and subject to new mining discoveries or even potential deep-sea mining in the future, Bitcoin is capped at exactly 21 million coins. This is enforced by code, not by physical extraction. In 2026, we are seeing the full impact of the Bitcoin halving cycles. The supply shock is real, as institutions like BlackRock and Fidelity have integrated Bitcoin into every major retirement fund. The demand has exploded while the available supply on exchanges has hit all-time lows. This is why many younger investors view Bitcoin not just as gold's equal, but as its superior. It is easier to verify, impossible to counterfeit, and you can send $1 billion worth of it across the planet in seconds for a few dollars in fees. Try doing that with a ton of physical gold. But we must address the volatility. In the final days of 2025 and moving into 2026, gold has shown its strength by hitting consistent all-time highs, while Bitcoin has experienced the wild swings that define the crypto market. For the conservative saver, this is the deciding factor. Gold moves slowly, like a giant ship, protecting your capital with low volatility. Bitcoin moves like a rocket ship, capable of massive gains but also heart-wrenching corrections. In 2026, gold has proven to be the safe haven, while Bitcoin has behaved more like a risk-on asset that happens to have a store of value narrative. When geopolitical tensions rise in the Middle East or Eastern Europe, gold is usually the first asset to react, absorbing the fear of the markets. Bitcoin often sells off with the stock market during these moments of panic, only to recover later as a hedge against the money printing that follows the crisis. The technical differences are where the stacking community finds its deepest arguments. Gold requires physical security, vaults, and insurance. It is heavy and difficult to hide in large quantities. Bitcoin requires digital security, private keys, and cold storage. If you lose your gold, it is gone. If you lose your private keys, your Bitcoin is trapped in the blockchain forever. Both require a level of personal responsibility that the average person sitting with their money in a traditional bank has never had to face. This is the core of the golden reset and the digital revolution, the return to individual ownership. Whether you hold a bar of gold or a hardware wallet, you are opting out of a system that treats your savings as its own capital. As we look at the macroeconomic landscape of 2026, the debasement trade is the dominant theme. Central banks are caught in a trap where they must choose between high interest rates that crash the economy or low interest rates that ignite inflation. In both scenarios, fiat currency loses. This is why the 2026 investor is no longer asking gold or Bitcoin, but is instead asking how much of each. Gold provides the floor, the stability that ensures you will never go broke. Bitcoin provides the ceiling, the explosive upside that ensures you can actually build wealth in a world where everything is becoming more expensive. The BRICS nations have accelerated their move away from the dollar, discussing gold-backed settlement systems, while the United States has moved closer to establishing a strategic Bitcoin reserve. We are living in a dual-track financial world. One track is built on the ancient, physical trust of gold. The other is built on the modern, mathematical trust of the blockchain. In 2026, The most successful stackers are those who understand that these two assets are not enemies, but allies against the inevitable decline of unbacked paper money. Gold protects you from the past. Bitcoin prepares you for the future. The decision of which is the ultimate store of value depends on your horizon. If you are looking to preserve wealth for the next 100 years for your grandchildren, gold is the undisputed champion with a 5,000-year track record. If you are looking to outpace inflation and potentially multiply your purchasing power in a digital-first world, Bitcoin is the tool of the new era. In 2026, the smart money is stacking both. They are building a fortress of physical gold and a bridge to the future with Bitcoin. The era of the paper illusion is ending. The era of hard assets is here. Whether it's 24-karat gold or 256-bit encryption, the goal is the same: financial sovereignty.